There is an ETF claiming it will pay you around a 28% yield weekly straight into your account. It has already attracted hundreds of millions of dollars, and at first glance it seems like the perfect replacement for a 9-to-5 job. Park your money, collect weekly cash, and walk away. But the real question is whether this is free money or whether you are slowly eating your own capital without noticing. Today we are breaking down how the so-called poor man's covered call actually works, how some high-yield ETFs generate payouts that look unreal, and the 3 hidden risks almost no one talks about. If you stay until the end, you will never look at a 28% yield the same way again. High-yield ETFs are like candy. They are sweet, they are addictive, and if you do not understand what is inside them, they can seriously damage your financial health. A good example is an ETF we will call QDT. What makes it special is that it uses a strategy known as the poor man's covered call to generate continuous option premiums, package those premiums into weekly distributions, and market itself as an income machine. But as always, there is a catch, and in this case there are several. We will break everything into 3 parts. First, the promise and the illusion of 28% weekly income. Second, the mechanism behind the poor man's covered call. Third, the hidden risks that can quietly undermine your investment through capital erosion, high costs, and market vulnerability. At the core of the problem is a simple idea. You see money flowing into your account every week, but you may not notice your net asset value slowly leaking out at the bottom. In other words, you are getting paid, but increasingly the money you are receiving may be coming from your own principal. We will return to this idea later. For now, let's decode the strategy itself. A traditional covered call works like this. You own a stock or an ETF, you agree to sell it at a preset price in the future, and someone pays you an option premium for that right. That premium becomes your income. Normally, you need to own 100 shares to run the strategy, which can be expensive. The poor man's covered call changes that. Instead of buying the full position, you buy long-dated call options, known as LEAPS, which give you long-term exposure to the asset. Then you sell shorter-term call options against those LEAPS. This allows you to collect option premiums with far less capital up front, which is why the approach is called the poor man's version of the covered call. Funds like QDT take this idea further. They buy leaps on something like the NASDAQ 100, giving them long-term exposure similar to owning the index. Then they sell extremely short-term call options, sometimes even 0 days to expiration contracts, which generate a large and frequent stream of option premiums. These premiums are collected, aggregated, and paid out to investors as weekly distributions. Because the fund is selling options constantly, the cash flow appears extremely attractive. Weekly payouts, double-digit yields, and the psychological feeling of earning income from the market all draw people in. In theory, frequent premium collection can be powerful, but that is not the whole story. The first major risk is net asset value decay. If you look beyond the yield and examine the underlying value of the fund over time, you may see a downward trend even while distributions remain high. This means your original investment is shrinking while the yield appears impressive. You may feel richer because you are receiving $100, $200, or even $300 per week, but if the share price is drifting lower and you never reinvest, you may actually be spending down your own principal. It is similar to cutting branches off a tree faster than the tree can regrow them. These ETFs are not simple index funds. They are actively managed, they use complex option structures, and they require daily decision-making. That means higher expense ratios, often around 1% or more, along with higher internal transaction costs. Every year, a portion of your returns is consumed by management fees, and another portion disappears through trading costs. So while the headline yield is 28%, the actual performance after fees, net asset value changes, and market conditions can look very different. These option-based high-yield strategies tend to do reasonably well in sideways, choppy markets where they can repeatedly sell calls and collect premiums. They struggle in other conditions. In slow, grinding downtrends, the underlying value decays while the fund continues paying high distributions, accelerating NAV erosion. In explosive upward rallies, the fund can repeatedly cap its own upside by continually selling calls, meaning the broad market may surge while your total return lags significantly. In a sustained downtrend, premiums may not offset the decline, causing losses to accelerate. Despite all of these risks, these funds remain incredibly appealing. They target people who are overwhelmed by bills, tired of their jobs, and searching for income they can enjoy now, rather than decades into the future. When someone sees a headline promising a 28% yield paid weekly, the emotional response is immediate. It feels like the long-awaited escape, the paycheck from the market that solves everything. But the truth is that there is no free lunch. Every form of yield requires a trade-off, whether it is risk, growth potential, or capital stability. A rational investor may conclude that high-yield ETFs like QDT are tools rather than foundations. They might belong in a small, controlled portion of a portfolio if they belong at all. Many financial professionals suggest limiting speculative or high-yield instruments to a small percentage of total holdings while maintaining the majority in diversified long-term growth assets. The mindset is simple. Use the tool deliberately, but do not build your entire financial life around it. On one side, you have a simple index ETF with low fees, clear structure, and the ability to capture broad market growth. On the other side, you have a high-yield options-based ETF with high fees, complex mechanics, and yields that may not translate into strong total returns. The core question becomes whether you prefer stable growth with moderate income or unstable income with uncertain long-term outcomes. The answer determines how you allocate your portfolio. Here is the full picture. A poor man's covered call is simply a way to generate income using leaps and short-term calls. ETFs like QDT industrialize this idea by selling options constantly and distributing the premiums weekly. The yield looks extraordinary on the surface, but behind it you may face capital erosion, high fees, and sensitivity to market regimes. Used carefully, these funds can serve as specialized tools for experienced investors. Used carelessly, they can quietly liquidate your future for short-term cash. If you found this breakdown helpful, consider liking the video so more people can avoid mistaking yield for safety. Subscribe if you want to see a future comparison between a simple index ETF and a high-yield option ETF over a 10-year timeline. And tell me in the comments whether you would prefer a steady 7% total return or a 20% yield with possible capital erosion. Type RISK if you want a full series on options-based income strategies from beginner to advanced.